Mortgage rates have finally dipped below 7% this year, and experts are forecasting more relief in 2026, potentially into the low 6% or even high 5% range. Some buyers are rushing in now, while others are still waiting for that perfect rate. So, what's the real smart move for 2026? In this video, I'll explain mortgage rates in plain English, share the latest 2026 forecasts, and give you practical home buying tips to save thousands and avoid big mistakes. Hey everyone, welcome back. If you're an American dreaming of buying a home in 2026, whether it's your first house, a move-up, or an investment property, this video is for you. I'm breaking it all down with no jargon, no sales pitch. Just straightforward facts and tips based on the latest data from sources like Fannie Mae, Freddie Mac, and the Mortgage Bankers Association. Let's get you ready to make a confident decision. First, the basics. A mortgage rate is simply the interest you pay on the money you borrow to buy a home right now. As of late December 2025, the average 30-year fixed rate is around 6.18%. Why does it matter so much? Take a $400,000 loan, a realistic amount in many U.S. markets today. At 7%, your monthly payment is about $2,660. Drop to 6%, and it falls to around $2,400, saving you $260 a month, or over $90,000 in interest over 30 years. Even small rate changes add up to big money. That's why tracking 2026 forecasts is key. Mortgage rates fluctuate, mainly due to three big factors. 1. The Federal Reserve, their rate. Decisions influence borrowing costs across the economy. 2. Inflation when it's high. Rates tend to rise to cool things down. 3. Overall economic health, strong jobs and growth can push rates up. Slowdowns often bring them down. For 2026, most experts predict gradual improvement. Fannie Mae sees rates dipping to around 5.9% by year-end. The Mortgage Bankers Association expects them to hover near 6.4%. Others, like Redfin and Realtor.com, forecast an average in the low to mid 6% range. Overall consensus? Rates should stay stable or ease slightly better than 2025, but no dramatic crash back to 3%. Stability means more predictable payments and potentially more homes on the market. Two main options in the U.S. Fixed rate most popular, especially 30-year. Your rate never changes, total predictability, perfect for long-term planning. Over 90% of buyers choose this for peace of mind. Adjustable rate ARM starts lower, maybe 5.5 to 6% initially, but can rise later based on market rates. Great if you plan to sell or refinance in 5 to 7 years, but riskier if rates climb in 2026's expected environment. A 30-year fixed remains the safest bet for most families. Here are 7 proven tips to position yourself for success in 2026. Tip 1. Boost your credit score. Now aim for 740 plus. Even 20 to 40 points higher can unlock better rates and save tens of thousands. Pay down debt and check your reports for errors. Tip 2. Get pre-approved early, not just pre-qualified. A full pre-approval shows sellers you're serious and lets you know exactly what you can afford. Tip 3. Focus on total monthly payment. Not just home price factor and property taxes, homeowners insurance, PMI if down payment 20% and HOA fees. Use online calculators to stay under 28 to 30% of your income. Tip 4. Save for a strong down payment to 20%. Avoids PMI and lowers your rate. But programs like FHA 3.5% down or VA 0% for veterans are great options if needed. Tip 5. Shop multiple lenders. Rates and fees vary. Compare at least 3 to 5 to find the best deal it could save you. $10,000 plus over the loan. Tip 6. Be ready for closing costs. Budget 2 to 5% of the home price for fees, appraisals, and more. Ask about seller concessions to help cover them. Tip 7. Don't chase the perfect. Rate or home buy based on your life needs and budget. Waiting often costs more in rising prices than a slightly higher rate.
At there.
You have everything you need to navigate mortgage rates and home buying in 2026 with confidence. Buying a home is a huge step.